Bismillahirrahmanirrahim. I'm Majidullah Khan, Assistant Professor, Institute of Business Studies, Guwahati University of Science and Technology, Guwahati. I'm teaching financial management. The course code is MS251 to BS Hospitality and Tourism and BBA. And today's topic is on valuation of long-term security. That is first online lecture. That's why it is lecture number 1. So, in this lecture, the topic will be covered is distinction among valuation concepts, that is specifically regarding the companies, what is bond valuation and what are the formulas that is used for bond valuation, preferred stock valuation, common stock valuation, and rate of return. So these are long-term securities that has been issued by the companies. Bond are issued by the companies for long-term financing. Preferred stock is also used to finance project in long terms. Common stock as well long-term securities that are used by the firms or listed company in order to get finances from general public. And the last one is rate of return. We will calculate also rate of return on these 3 type of long-term securities in this long-term security valuation topics. There are multiple lectures on long-term valuation of the valuation of long-term securities. Moving further, what is value? First, liquidation value. Liquidation value refer to the amount of money that has been received when the company goes bankrupt and the assets are sold separately in open market. In case of liquidations, the company are no more going concerns and unable to pay its short-term obligations. That's why it is declared as bankrupt or liquidated. SCCP appoint a liquidator and dismiss all the management. This liquidator sold these assets separately and realized money in order to pay those people who have claimed against the company. Now, going concern value represents the amount of firm could be sold is continuing operating businesses. For example, company A Limited is used as let's suppose A Limited is a company and it is acquired by B company is going concern. So B Limited just buy shares of the company in open market and then sit in the board of governors and control this A Limited. But the A Limited work is going concern. It is not liquidated. It is called going concern value or market value of the company. So when shares are sold and purchased, this is the value that have been realized or referred as going concern value. What is book value? Basically, book value is that's are booked or that is recorded on a balance sheet. So often the book value is basically equity section. All equity section means that is equity, common share premium, general reserve, retained earnings, or any type of reserves, as well as considering a treasury stock as well. Then this total equity portion amount is divided by number of outstanding shares. So it becomes then the book value of the company. So if we say that the asset have a book value, that is accounting value of an asset. The asset cost minus its accumulated depreciation. If we refer to the book value of the whole firm, total asset minus liability in preferred stock is listed on the balance sheet. So when we deduct liabilities, means all liability, long term and short term from assets, preferred stock, then what remain, what is remaining portion in total asset? That remaining portion is equal to that equity section of the companies. So all amount that is included in equity section is called book value of the company. Market value. What is market value? Market value is represent market price at which assets are traded. Means that is defined by supply and demand, or willingness of the buyer and sellers at which they are agreed upon. So market value represents market price at which assets are traded. Usually in finance we refer to the share prices on the stock exchanges. Share prices on stock exchanges. It is called market value. Stock exchanges in Pakistan, we will just mention one stock exchange, that is Pakistan Stock Exchange, PXE. Intrinsic value. So what is intrinsic value? Intrinsic values means we have different factors that we consider and then said that that should be the value of the company. It is basically market price. Maybe market is affected by momentum, market is affected by herd behavior, market is affected by any other emotion of the investors or buyer or sellers. But intrinsic value is based upon certain factor that we consider the factor, and then we decided that this should be the price of the asset. Intrinsic value represents the price of securities are to have, that what should be the value based on all factors bearing on the valuation. Let's suppose if we talk about the share of companies, let's suppose in this year, in 2020, 20 share of oil companies, let's suppose OMCs, oil marketing companies like Shell, like PSO, like APL. So the market value might be high or might be low, but on the factor that what should be the value of the oil companies, we will consider these things: earning of the oil companies, dividend of the oil companies, growth of oil companies in future. So all these things will, and what should be the required rate, means of the investor who will go to invest, required rate of return of the investor who will invest in OMCs. All these things will determine the price of the share price of the oil marketing company. So intrinsic value is basically calculated based upon certain assumptions, certain factors that have an impact on the valuation of the companies. What is bond valuation? We will discuss first of all in long-term securities bond. In bond, we will discuss important terms. What are important terminologies that were used specifically in relation with the in relation with the bond. Important terms: type of bonds, valuation of bonds, handling semi-annual compounding. Means semi-annual, we will discuss semi-annual as we have already discussed the semi-annual compounding, quarterly compounding, as well as annual compounding in earlier chapter of time value of money. So important terms. What is bond? Bond is basically long-term instrument that is issued by corporation or government. In Pakistan, probably you will, if you check the annual report of the companies in Pakistan, you will rarely see that any company issues terms finance certificate, TFCs, which is also one type of bond. So it is longer term, might be more than 5 years that the company issue bonds to the people and collect money from them in order to finance their long-term project. It is issued by corporation, means public limited companies, or by the government. That is, government oftenly issued the bond, longer term bond, in order to finance certain projects. These bond may be issued locally or may be issued internationally. So bond is basically long-term instrument issued by the two entities. One is companies and other is government. When they issued these bonds, the people buy or purchase their bond and invest them in their longer term project. Maturity value. What is maturity value? Maturity value means that how much time is remaining in order to get the amount invested in the bond. Bond is basically one type of loan. So maturity or face value of the bond is stated value. Maturity value. In case of US bond, the face value oftenly mentioned in thousands, $1,000. So maturity value means, let's suppose a limited issued a bond of ₹1,000 each. So the people will deposit or will submit or invest 1,000 and will get this bond. So the people will give ₹1,000 and will get this bond. Now this bond will mention that how much is its maturity time. If it is 10-year bonds, then it will be, let's suppose it's 5-year bond. The company is liable to pay ₹1,000 after 5 years. So this ₹1,000 that the company will pay to this investor back is called maturity value. Coupon rate is basically, the bond will also mention that how much the company is liable to pay on these 1,000. Let's suppose the company say that it is 8% coupon bond. Then the company will give ₹80 interest to each bondholder per annum. Discount rate. The discount rate, capitalization rate, is dependent on risk of the bond. It is composed of risk-free rate plus premium for the risk. This is basically the rate that is available to the investors. If investor have an opportunity to invest their 1000 rupees on 10%, they will never invest in 8% bond. If an investor have an opportunity to invest their 1000 money at 9%, then they will invest somewhere else instead of 1000 bond. So this discount rate is basically depend on the risk of the bond, and it's composed of risk free plus premium for the risk. Different type of bond. Let's suppose we say that the bond that have zero coupon rate and issued and have no maturity. That is called perpetual bond. What is perpetuity and what is annuity? In annuity we have equal amount, equal interval, equal amount, equal interval, and specific time period. Amount received or paid. But in perpetuity there is no specific time period. It is forever. If you received or paid equal amount after equal interval and forever, it is called perpetuity. So this is called perpetual bond that never mature. It is an infinite life. So what will be the value? Value of the bond will be that you received interest I. Let's suppose if 8% coupon bond, then 80 rupees divided by KD is basically required rate of return. That is you want to receive on bond, or you will invest in same type of risk. So that is your discounted rate, which was used as interest rate and time value of money. So you will get present value of the first year of interest. Then you will get discounted by your required rate of return second year present value. Then after all you will move towards infinity. So you will first convert all your interest that you will receive on a bond into present value. So what we will do, that we short this expansion, that summation t is equal to 1 up to infinity 1 divided by 1 plus kd raised to the power t. If we give t1, that it will give this value. If we give value 2 to the t, that will this value, and infinity. But in reduced form, the value of perpetual bond will be interest divided by your required rate of return. That is a reduced form of this whole equation. In questions or in exercises, we will use this formula for perpetual bond, that is interest divided by required rate of return. Interest received or paid divided by required rate of return, but only for perpetual bond. Perpetual bond means that have no maturities and it gives you interest for infinite life. Next, perpetual bond example. Let's suppose bond P has 1000 face value and provide 8% annual coupon rate, that is coupon rate basically. The appropriate discount rate. This is discount rate means the rate at which you are willing to invest in same kind of bond or at the same risk level. What will be the value of perpetual bond? As I mentioned, that V is equal to I divided by KD. I is 8%, that is $80, and discount rate is that 8% divided 10% divided by 10%, you will get your value. So 1000, first of all we will calculate or interest 1000 multiplied by 8%, that is $80 per annum. If you buy this bond, then you will get $80 per annum. Your required rate of return is 10%. So I divided by KD, 80 divided by 10%. So you will buy this 1000 bond on 800. Means you are willing to pay to the bond in a secondary market that have 1000 face value because of your required rate of return. So the bond is selling at discounted rate in the open market. It has face value of 10, but intrinsic value is $800 upon the calculation of the valuation of the formula. Moving further, different type of bond, that is non-zero coupon paying bond, is coupon paying bond with finite life. Means this bond will give you, this bond basically provide you a coupon. It is same as perpetual bond, but it have finite life. Perpetual bond have infinite life. So what is the difference? The difference is that if you invest in such type of bond, it will pay you maturity value after certain time. Let's suppose if it is 10-year bond, it will give you maturity value back after 10 years along with the interest. So this bond will give you I amount of interest in first year, then I amount of interest in second year, then I amount of interest in third year, and similarly I amount of interest in n years. You will discounted these all interest on required rate of return. So it is one type of you may say that is annuity, that interest amount is same after equal interval of time and for specific time period, so it is annuity. Now after last year when you will receive your maturity value, it will also be discounted at your required rate of return. So the formula is T is equal to 1 up to n summation 1 divided I interest divided by 1 plus required rate of return raised to the power t plus maturity value 1 plus k required rate of return raised to the power n. So if we give this t1, we will get this factor. If we will give the value to t2, we will get this factor, 3 this factor, and n this factor. Further, instead of dealing with such hard type of mathematics, we will reduce or we will rely on our time value of money table. So the value will be I. I is basically equal amount of interest after equal interval of time into a specific time period, so it is annuity. We will use annuity formula for this present value, which is for the required rate of return and for the specific time period. Now this maturity value is one-time payment that you will receive after maturity, so we will discount it with the present value single amount. We will use different type of table here. Now examples. Bond C has 1000 face value and provide you 8% annual coupon for 30 years. So there is 30-year bond. The bond will be mature in 30 years. Appropriate discount rate is 10%. What is the value of coupon bond? So value as, first of all, we will calculate our interest. How we will calculate our interest? We will calculate our interest by multiplying 8% with this 1000. We will get $80 it is calculated as 1000 multiplied by 8%. So we will get this amount of interest. This amount of interest will be received for first year, second year, third year, fourth, fifth till 30th year. So that is one type of annuity. Equal amount is received after equal interval of time and for specific time periods. We will use present value table. So this amount is basically this amount this we will see it for 10% is our discount rate, and below and in 30 and in 30-year row. So this is 10% in table. In annuity table, we will see below in this column in front of 30-year, we will see that which amount, which value is placed here. So that value is 9.427. We will pick this value and will put in this formula 80 multiplied by 9.427. This value has been extracted from present value table of annuity, and this is single amount that we will receive after 30 years. So we will get present value factor in a single amount table below 10% in front of 30 year, which is 0.057. So this value has been extracted from present value table of a single amount. Multiplication of this result in this amount, and multiplication of this result in $57. When we add these two amounts, we will get the value of bond is $811.16. So this bond is also sold and purchased in open market on discounted prices. Face value is 1000 and it is selling, or its intrinsic value is $811. This is because the people have an opportunity to invest their money somewhere else, which give them 8% returns. Means this at the same risk level. If this bond have a risk level, at the same risk level, if they invest somewhere else, it will give you them 10% return instead of 8%. So the people will not buy this bond. It will buy only this bond if it is available on discounted prices. Thank you. This is all about today's lecture. See you in a coming lecture.